Hello and welcome to another Lion's Mane tax training video. This video is in response to questions about the quarterly estimated tax payments as well as penalties for late or no filing as well as failure to make these prepayment penalties. So what are we talking about? When you own a small business, if you don't already know, nobody is withholding your taxes for you. So for people who are prior W-2 income earners, they might not be aware that unlike for W-2, where all of your taxes are withheld, for small businesses, you have to do that yourself. And so our goal here in this conversation is how do we set enough money aside to pay for taxes come April? Or how do we make sufficient deposits to the IRS so that when we do file our taxes in April that we don't owe anything? And really, there are just two thumb rules here that you want to follow. If you're receiving a W-2 income, just keep doing what you're doing, right? That W-2 income is already being taken care of by the form W-4 that you filled out when you got hired. But for small businesses, the general rule is you want to put 20% aside to make sure that you have enough money to pay for taxes, with two caveats. If you make over $300,000 a year, you should add 5% to that, just because your average tax bracket will increase, right? Or if you live in a state that does not have income tax, like Texas or Florida or whatever it is at the time of this video, you can generally take 5% off. But thumb rule, 20% across the board and you'll be okay. For investment income, so think like capital gains or things from the stock market, you're going to want to set aside 25% to cover those taxes come April. So there are two ways to do this, because what you have to do is figure out, okay, 20% of what? How much money do I need to set aside? What's going on? So you can either consider the percent of your gross income, or you can take the percent of your take-home pay. So gross being customer pays me $1,000, whether it costs me $500 or no dollars to fulfill what that customer paid me for, that $1,000 is gross, right? And then your take home is everything after expenses. So if you had $1,000, it cost you $500 to sell the widget to the customer, your take home is $500. So that's what we're talking about. So let's discuss how numbers might look if you choose to take a percentage of gross income. Okay, so here's two examples. You have somebody like an influencer or a real estate agent, somebody that doesn't have any overhead or very little. So no employees, the cost of goods sold is very low. So we're just going to say this person made $200,000 in gross income, and then they had $50,000 of expenses. So if you are choosing to do the percent of gross, we recommend 15% set aside for taxes of your gross income with low overhead. So in this specific example, you can see $200,000 gross, $50,000 of expenses. That's $150,000 of profit. Then, because we're using the S Corp strategy, we are devoting 70% of that to payroll. So your net income is $80,000. So that's your profit minus payroll expense, being $70,000. So your adjusted gross income is $150,000. If you take your standard deduction, that lowers you to $122,000 of taxable income. Now, if we look at this, we're going to have $10,000 coming from FICA. So that's 15.3% of our payroll, right? And then we're going to have our federal income tax, and this is just based on the tax tables of 2024 specifically. And then your total tax that will be due in April is $28,231. So let's check ourselves. We said we're going to take 15% of gross income. That's $30,000. So we set aside 30 grand, and it's going to cost us just a little over 28,000 to cover all of our taxes. Good. That's great. That's almost perfect. Okay. For our clients that are more overhead heavy, so like construction companies, decking companies, anybody with like a lot of employees or the cost of goods sold is very high, we're actually going to be taking 9% of gross. So in this example, we have a client rather making $400,000 of revenue, right? Money coming in. And then we're taking 9% of that, and that's $36,000. The numbers here are going to play out nearly the same from this point because I just made it almost the same amount of profit. And then you're going to see of our $36,000 that we set aside, the total due was $34,831. So 36,000, 35,000, almost perfect. So again, if you're a low overhead industry, so influencers, things like that, we're going to want to set 15% aside of every penny that comes into your income. And again, there's two caveats. I'll just close it out one last time. A, in this example, our client is in a no state tax state, right? So if we were in not Texas, you would want to do 20% because we're adding our 5%, and then that would cover your state taxes. Also, this client is not making more than $300,000, so we don't need to add 5% onto that. Okay, now if you are in a high overhead, so you have to buy a bunch of lumber, you have a bunch of employees, things like that, then we're only going to take 9% of our gross income. And that's purely because it's very, very hard to determine what the actual cost of goods sold is going to be. So what are all of your expenses at the end of the year, right? So we're just going to estimate with 9% of our gross income. And you'll see it does map out just about perfect, assuming we're following that S-Corp strategy and you're in a state with no income tax. If you're in a state with income tax, we're going to, again, add 5% there. So those are the caveats to my examples here. So that was talking about gross income. Customer pays you, boom, set some money aside for tax. Now let's talk about percentage of your take-home pay, right? So in this case, we're talking money after expenses, but before payroll, right? So you have same numbers as last time, $200,000 as an influencer. You have $50,000 of expenses for your sets or whatever, so you're at $150,000 of gross profit. You want to set 20% aside for gross profit. 150,000 times 20% is $30,000. You have completely covered your tax bill. Okay, and then we are not changing the percentage. It's 20%, whether you're an influencer or whether you're a construction company. You want 20% of gross profit. Your advisor should be telling you this, but the important thing to consider is forget take home and forget gross. If you're a low overhead client, think influencer, think real estate agent, we want you to do percent of gross. So every check that comes in from a brand deal or every payment from YouTube, take 15% of it right off the top. And if you want to be safe because you live in a state that has income tax, or you want to make sure that you're not going to be under at all, go ahead and just bump that to 20% on all of my businesses. That's what I primarily advise everybody to do, 20%. Okay. If you are high overhead, so this number right here could fluctuate very heavily up or down, right? So if you can help it, you really should be trying to push for percentage of take home. Okay. So high overhead, high expenses, your advisor is going to ask, hey, what are you taking home every day or at the end of the month, right? And then that's what we're going to do all of our math off of. So overhead, the take home, that's just not what we recommend. Again, you're welcome to proceed with the strategy you prefer. But again, influencers, gross, construction companies, take home. All right, real quick before we move on to penalties, I do want to touch on one other concept. So remember, we're taking these amounts of money, right? And then we're dividing it by 4. So if you were to take this $28,000 here, that's basically $7,000 times 4. So what you should be doing is putting $7,000 of taxes in quarterly, right? So some of that's going to be FICA and some of that's going to be estimated income tax. FICA is coming through your payroll provider. We'll handle that if you're working payroll with us. And then the remainder of that is going to come straight to the IRS into your estimated tax payments. That's something that you'll have to do unless you're a fractional CFO client. Then we handle that. Okay, but the point is the IRS is looking for quarterly payments, so you should be putting the 7K in every 3 months, and that's how you're going to avoid penalties. Now, some people like to put all $7,000 in as their tax deposits. And well, what happens if I don't do that? And we'll talk about it in a little bit, but it's about 3-ish%-ish. And some people say, hey, if I had $7,000 in the stock market over 3 months or over the year, I can get 8% return. So 8% of positive minus 3% of negative for my interest is still a net positive. So I can handle my money a lot better than the penalty that I'm going to get for not doing those deposits. So personally, what I like to do is I do about 50-50. We put 50% of our money in as estimated tax payments, and then we take the other 50% and we put it into a high interest savings account. How you choose to weigh that depends heavily on what you and your advisor discuss, and you can figure out what's best for you of what exactly you want to do with your money. But again, the IRS is looking for 4 quarterly payments to get to your total, right? That's what they want. All right. Lastly, the least fun part here is penalties, right? There's 3. There's late payment penalties, there's failures to file, and then there's penalties for underpayment of estimated taxes. If I was to ask you when are taxes due, you would probably tell me April 15th. That is when the payment is due, no matter what. We can extend to go all the way out until October to file, okay? And that's really important distinction here. No matter what, when you figure out how much you owe, sometimes it'll be after April, but when you have a guess, right, of how much you owe, it has to be in by April. So you've made your quarterly payments, you do some math, you say, I am $2,000 short. April 15th, you have to have that $2,000 in, right? And that will help avoid your late payment penalty. And I wouldn't worry too much about the late payment penalty, because if we do, for example, extend your tax filing to October, so let's say you owed $10,000, right? $10,000 between April and October, the interest on that and penalty is like $550. You can check me on that. So that's not bad. $550 on the $10,000 that you owed. I think we can live with it. If you just don't want to worry about that at all, you can always just overpay. Now, this is the big one, failure to file. If you did not extend your tax return and you do not file your personal taxes by April 15th, you are going to get a 5% per month penalty for not filing your taxes. You might be asking yourselves, well, how does the IRS know how much I made if I didn't file? That's part of the problem. If you're not reporting anything, then they have to start getting creative, and they don't really like that. So they're going to hit you, and they're going to hit you hard. So they're going to do things like add up all of the 1099s that you've been issued. All things that you can get from your transcript, by the way, something that we do. And then they're going to slap you with 5% a month on that failure to file. So we really want to avoid that, and that's why all of our clients are going to automatically file for extension for you unless you explicitly ask us not to. Okay, and then lastly, you have the penalty for underpayment of estimated taxes. So this is the penalty for not doing what the rest of this entire presentation was about. And that's about 3% of the owed, and that's where I was talking. That's where you have to kind of weigh, hey, what am I doing with my payments? And so how do you avoid this underpayment of estimated tax penalty? Well, it's impossible to be perfect on paying those estimated taxes. So there is a safe way. If you're paying 90% of those taxes, even if it's a little bit short within 10%, you're going to be okay. No penalty. Or kind of an easier way to do it is if you pay exactly what you owed last year, or 110% if you're making over 150,000 in quarterly payments, then you will not get a penalty even if you're wrong, right? So let's simple math. Let's say you owed exactly $4,000 last year. As long as you're doing $1,000 a quarter, you're good to go. And then let's say you made $150,000 or more, right? Then you would want to do $1,100 4 times, right? And you'd be good to go. And then I'm not going to bore you reading this. You can pause this video and zoom in. These are when the estimated tax payments are due, or when it's due, and for what time period. So if you're watching this and you're preparing for taxes, right, it's probably January, maybe February. All the money that you made in January, February, and March is going to be due April 15th, those estimated taxes on that. In conclusion, hopefully this gives you a good background on to determine how much to pay. So if you have any questions at all, please let your advisor know and he'll work to answer those questions. Thank you.